Okay, hello everyone. So today we are going to cover complete revision of all fixed and variable overhead cost variances. Again, I had given one question, this question number 17 from question bank. Those who are not on Telegram channel, you can pause the video right now, take a screenshot, try to solve and then come to the video. First we'll revise all the formulas and then we will solve this question. Okay, so let's start. Let's revise all the formulas of variable and fixed overhead cost variances. If you understand logically, they are very easy. Okay, so let's revise. First, let's start with variable overheads. For either of two, variable or fixed, your first step in variance calculation should be calculating standard recovery rate SRR per unit and SRR per hour. That should be your first step. SRR per unit is what? Budgeted overheads divided by budgeted units or budgeted output. Similarly, SRR per hour will be what? Budgeted overheads upon budgeted hours. So this has to be your first step in calculating variable or fixed overhead variances. Then let's start with formulas. Variable overhead cost variance. Now, variable overhead cost variance behaves similar to labor or material. Okay. Formula of variable overhead cost variance is what? SRR per unit into actual output minus actual variable overheads. Okay. Always remember that all the formulas can be converted. Converted means what? Concentrate. If you have actual output, then you can convert it to standard hours for actual output. If you have, let's say, something called as, let's say actual hours. Then if you want, you can convert it to standard output in actual hours. Okay. If you have budgeted hours, you can directly convert them to budgeted output. That's it. Okay. So in short, if you want to convert output to hours or hours to output, then actual becomes standard or standard becomes actual, but budgeted remains budgeted. So for example, if you want this formula in terms of hours, SRR per hour, let's say, then what will you do? Instead of actual, we'll take standard. Instead of output, we'll take hours. That's it. So this is another formula. I suggest while remember the main formula only and just know how to convert it so that in exam if needed, you can convert. Next, two parts of this are variable overhead expenditure variance and variable overhead efficiency variance. Expenditure variance is easy to remember, is just instead of this, write SRR per hour into actual hours minus actual variable overheads. Understanding the logic behind this is very important. Okay. But right now we are focusing on formulas revision. Logic also I'll explain in some separate video. Also it is there in the main batch which is there on the channel. Okay. So this variable overhead expenditure variance. This is nothing but labor variance only. Formula similar to labor variance only. How? Can I write this as standard rate into actual hours minus actual overhead means what? Actual rate into actual hours, right? So if I just take actual hours common, what will be in bracket? SR minus AR. This is nothing but formula of labor rate variance, right? Fine, but fine, easy to remember like this also. If you want this to convert this into output, actual will become standard, hours will become output, standard output in actual hours. This will become SRR per unit and then minus actual variable overheads. That's it. Again, remember the first one only. Efficiency variance, anywhere efficiency variance comes three times: labor, variable overheads, fixed overheads. Everywhere formula of efficiency variance is same: SH minus AH, standard hours minus actual hours into SRR per hour. Again, if you want to convert to output, it will become actual output minus standard output in actual hours into SRR per unit. Again, remember the first one only, not the second one. Fine. Based on this, let's calculate variable overhead variances for that question first, then we'll go to fixed overheads. Okay. Let's see the question. XYZ has furnished you following information for the month of August 2022. Budgeted actual, output hours, fixed overheads, variable overheads and working days. Fine. So, like I said, first thing that we have to calculate is SRR. Now this is variable overheads first. So SRR per unit and SRR per hour. SRR per unit is what? Budgeted overheads upon budgeted output. We have everything. What is budgeted overheads? Variable overhead 60,000 and budgeted output is 30,000, right? So 60,000 by 30,000 is 2. Then SRR per hour. SRR per hour will be budgeted overheads upon budgeted hours. That is again 2 only, right? Now let's calculate variable overhead cost variance. SRR per hour, SRR per unit, let's use unit formula, which is the basic one, into actual output minus actual variable overheads. SRR per unit is 2 into actual output is how much? They have directly given it 32,500, right? So 32,500 minus actual variable overheads are 68,000. So let's check how much this is. 2 into 32,500. Let me check it just a second. 2 into 32,500 minus 68,000, that is 3,000. Don't consider negative or positive. 3,000. Actual is more, right? The 68,000 is more because 32,500 into 2 is 65,000. So that means actual cost is more. So this is adverse. Don't go by negative, positive. It will not work everywhere in fixed overheads. Next, variable overhead expenditure variance. Expenditure is, like I said, write the same formula but write hours. So SRR per hour into actual hours minus actual variable overheads. Again we have everything. 2 into actual hours they have given in the question, 33,000 here, second line, minus 68,000. So that is going to be 2,000. Again adverse because actual variable overheads are more. Okay. Next, variable overhead efficiency variance. Efficiency variance, like I said, always same formula, SH minus AH into SRR per hour. SH minus AH, standard hours minus actual hours. Now we'll have to calculate standard hours. Standard hours calculation is very important and it will be same for fixed overheads also, right? Let's calculate here in this box. Standard hours for actual output. Always write it like this, standard hours for actual output. Concentrate. Now, as per budget, understand, budget is our standard also, right? On per unit basis, whatever we budget, when we prepare the budget, that is as per our standards, right? So budget, always we can get standard data from budgeted data. Okay. Now understand, in budget, they are saying in 30,000 hours, 30,000 units are produced. Okay, that means hours units. So 30,000 hours, 30,000 units. Now we want standard hours for actual output. What is actual output? Actual output is 32,500. So just we have to cross multiply and calculate for 32,500 how much, right? For 32,500 how much? So it will just be a simple ratio, this upon this is equal to this upon this. So if you check, that question mark is going to be 32,500 hours, right? Okay. Now let's calculate SRR per hour 2 into standard hours 32,500 minus actual hours must be given 33,000. If you check, it is 1,000 more, 500 more hours. So 1,000 adverse. More hours means adverse, right? Cross check, 2,000 adverse plus 1,000 adverse should be equal to 3,000 adverse. It is matching, right? I will not stop here. We will not go to fixed overheads. Let's calculate everything with units formulas also. Okay, now you'll have to concentrate carefully. Let's convert all the formulas. If we convert this formula, actual output will become standard hours for actual output. Okay, actual is standard, output is hours. Then SRR per hour minus actual variable overheads. Now we have everything. Standard output is what? 32,500 into 2 minus 68,000. If you check, it is going to be same, 3,000 adverse, right? Same. Next, concentrate expenditure variance. Okay, next, expenditure. SRR per hour will become SRR per unit into actual hours will become standard output in actual hours minus actual variable overheads. Again, standard output in actual hours, we can do the same. On standard basis, 30,000, 30,000 is the ratio. So in actual hours are 33,000. What should be the output, standard output? So if you check the ratio, it is going to be 33,000 only. So 33,000 into 2 minus 68,000. If you check, it is still 2000 adverse. Right, same. Sometimes you don't have the data, so you have to go to this formula. And last, efficiency, SRR per unit into, just a second, yeah. So a standard hours will become actual output, and actual hours will become standard output in actual hours. So let's calculate 2 into actual output was what? 32,500 minus standard output in actual hours is 33,000. We just calculated here, right? So answer is going to be same, 1000 adverse. So in this way you can use both the formulas to calculate if variable overhead variances, same for fixed overhead variances. This is important in exam because if some question comes where there is no data given of units or hours, then you have to use the other formula. This is also very useful in missing figure questions. Okay, so I hope this part is clear to everyone. Fine. Let's solve the fixed overheads in separate video, fixed overheads part, so that let me keep only variable overheads in this video. So I hope this variances and all the alternate formulas are clear to everyone. If yes, let's stop this and we'll continue in the next one. Okay, bye everyone.